Rent feels impossible to escape, feels normal, but it is rarely accidental, and the structure behind it is the reason why. For decades, economists and policymakers treated renting as a temporary stopgap. The standard assumption was a simple life cycle. You rent when you're young and starting out, and then, as you age and save, you naturally transition into homeownership. This demographic distribution chart shows how that cycle has broken. The baseline of young renters hasn't remained static. It has expanded outward, swallowing up older age brackets and higher-income households. A third of all U.S. households now rent, including middle-income families and older adults who are no longer transitioning into ownership. The mechanism to move from renting to owning has stalled. Notice how this chart compresses into a steeply sloped supply curve. This visualizes a market where the friction is so high that it is nearly impossible to convert existing rental stock back into owner-occupied homes. The housing market has tightened into a permanent state for millions. Renting is no longer a transitional phase. It has become a durable, involuntary destination for a growing portion of the population. This shift is driven in part by algorithmic revenue management, software platforms like RealPage's YieldStar that have automated the pricing of shelter. In the previous market model, independent landlords competed for tenants. If an apartment sat vacant, a landlord would lower the rent to fill the unit, creating localized price competition that benefited renters. This animated map shows how software removes competition. Rival landlords feed non-public data into a shared algorithm, replacing individual price tags with synchronized recommendations to maximize collective profit. The governor feature establishes a firm price floor, restricting downward adjustments, maintaining high rent targets. Landlords are pushed to comply through auto-accept functions and software monitors. If a tenant tries to negotiate, the property manager defers to the algorithm's fixed target, effectively removing human discretion from the leasing office. The Department of Justice has sued to stop this practice, alleging that this network functions as a digital cartel. According to federal investigators, the software pushes rents aggressively, even in markets where the supply of new housing is actually increasing. By synchronizing prices across a neighborhood, technological coordination eliminates a renter's exit option. Tenants are forced to pay these rates because there are no longer any independent, competing alternatives in the area. While software manages the price, a new type of owner controls the supply. Global corporate landlords, or GCLs, have used massive capital to institutionalize the single-family rental market since 2008. These institutional buyers frequently bid over asking prices, outcompeting local families and removing entry-level homes from the purchase market entirely. This chart tracks rent against income. As the cost line rises and income remains flat, the red space between them, the capital needed for a down payment, disappears. This shrinking space is then capped by a heavy ceiling labeled zoning restrictions, preventing affordable apartment construction. These two loops lock together. Renters are drained of the capital they need to buy, while local laws prevent the construction of the supply that would force their rents down. To understand why this structure remains in place, we have to look at federal tax policy. The United States tax code provides a massive legal advantage to property owners at the direct expense of those who rent. Watch federal tax subsidies stack up on the owner side, providing over $200 billion to homeowners annually. Renters receive zero. In fact, tracing monthly payments upward reveals renters implicitly pay their landlord's property taxes, which the landlord then deducts. This creates a liquidity trap. Huge portions of household income are diverted away from the productive economy, like innovation or education, and into the passive extraction of rent. The resulting system engineers a continuous wealth transfer, pulling capital from a trapped renter class and funneling it toward a subsidized owner class. So the effect is not random, it is structural, and now you see it a little more clearly.